Welcome to The Explainer. Today, we're diving into the kind of tax mistakes that can literally kill a small business. We're not just going to point them out, we're going to show you how to sidestep them completely, all based on some really sharp insights from tax expert Cabello Molad.
Okay, let's just start with a number. 180 million rand. Nope, that's not a typo. That's the real actual tax bill that a single trucking company found themselves facing. It's just an unbelievable figure.
So the big question is, how on earth does that even happen, right? Well, it wasn't one big mistake. It was more like a death by 1,000 cuts, a whole series of little misunderstandings and compliance slip-ups that just spiraled into a monster. Let's dig into exactly how that happened.
So here's the anatomy of the disaster. The company's revenue crossed the 30 million rand mark. Now the law is crystal clear on this. Once you hit that number, you have to file your VAT returns every single month. But they didn't. They just kept filing every other month, and for the months they skipped, they filed what's called a zero return, probably thinking that would keep the tax man happy for a while. That was the fatal move, because every one of those missed filings started racking up penalties and interest, turning what was probably a manageable problem into a completely unstoppable, business-crushing avalanche of debt.
To make sure a nightmare like that never ever happens to you, you've really got to get your head around the three main pillars of business tax. This is the absolute bedrock of staying out of trouble.
First up, you've got income tax. This is the one most people get. It's pretty straightforward, really. It's the tax you pay on your company's net profit at the end of your financial year. If you make more than you spend, you pay tax on what's left over. Simple.
Next is VAT, or value-added tax. The easiest way to think about this is that your business becomes a kind of temporary tax collector for the government. You add VAT to what you sell, you collect it from your customers, then you get to subtract all the VAT you paid on your own business expenses. Whatever is left over, that's what you hand over to SARS.
And finally, there's provisional tax. This one's actually a pretty smart system. Think of it as a couple of interim check-ins during the year. It's designed to help you pay your big annual income tax bill in smaller, more manageable chunks. It's all about preventing that one giant, heart-stopping bill at the end of the year.
So, you see, you're basically juggling three different clocks at the same time. You've got your big, once-a-year income tax deadline. Then you've got the more constant rhythm of VAT, which could be monthly or every other month. And then you have that twice-a-year check-in for provisional tax. Keeping these timelines straight is honestly where a lot of businesses start to go wrong. Okay, so we've got the basics down. Now let's get into the nitty-gritty. What are the most common business-killing mistakes that owners make? Turns out, there are three major ones that pop up time and time again. And here they are, the top three tax traps. Number one, just plain, bad, messy record keeping. Number two, that really tempting but super dangerous zero return shortcut. And number three, one that catches a lot of people by surprise, not properly managing the money you borrow from your own company. Let's break these down.
Our expert, Cabello, couldn't have been clearer about this. It all starts with your paperwork. And here's the key. A bank statement just isn't good enough for SARS. Sure, it shows that money left your account, but it doesn't prove why. You absolutely need the actual invoice to prove that an expense was legitimate and that it was for your business.
And this one takes us right back to that trucking company. It's so tempting to just file a zero return to hit a deadline, telling yourself you'll sort out the real numbers later. But that isn't being compliant, it's just setting a ticking time bomb. Sooner or later, an audit is going to find it, and by then, the damage is already done.
So, you might be thinking, how can I manage my tax bill in a smart way without, breaking the law? Well, it all comes down to understanding one really, really important difference.
And this slide just lays it out perfectly. There's tax avoidance and there's tax evasion. Tax avoidance is totally legal. It's just smart planning, structuring your business in the most tax-efficient way the law allows. Tax evasion, on the other hand, is when you deliberately lie, hide, or misrepresent things. That's a crime. The goal is to be strategic, never deceptive. Okay, so let's shift gears and talk about solutions. What can you actually do? Here's a simple playbook, some concrete steps you can start taking right now to keep your business healthy and safe. Look, the most important thing is to be proactive, not reactive. It all starts with keeping perfect records. We're talking invoices for everything. Next, get a pro on your team. A good tax practitioner is worth their weight in gold. You've got to know your deadlines inside and out. And always, always declare your activity, even if you made zero income, because you still have an obligation to report. And finally, treat your business like a separate person. If you borrow money from it, draw up a proper loan agreement.
Now, if you're listening to all this and your heart's beating a little faster because you know you've made some of these mistakes, just take a breath. The best advice from the expert is simple. It is never too late to start getting it right. The most powerful step you can take is the one you take today.
So we'll leave you with this final thought. Being truly tax compliant isn't really about fear or avoiding punishment. It's about building a professional, stable, and sustainable business. It's a sign of a healthy operation. So, it's worth taking a moment to ask yourself, honestly, is your business truly compliant, or have you just been lucky so far?